Welcome back to the CPA Revolution. I'm Charina Padilla here with our tax strategy expert and co-host, certified tax coach and CPA, Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. Welcome back to the CPA Revolution. I'm Charina Padilla and here with our tax strategy expert and co-host, certified tax coach and CPA, Jose Ortiz. So today we're talking about the excess business loss. Most business owners think that their business show a loss and automatically it wipes out their taxable income. But here's the reality. The IRS has a set ceiling and it's called the excess business loss limitation. What's the kicker? Most people don't even know it exists until it's too late. That's why today we are exposing one of the biggest hidden tax blind spots for entrepreneurs and high earners and showing you how a proactive strategy makes the difference between a nasty surprise and a massive tax win.
All right.
Jose, let's get started with your, the summary, the unseen tax blind spots. Tell me about it.
Yeah. So very much like you said just now in your intro, it's where we get people coming in who they're high earners, obviously. So one of the most common things that they think intuitively is, hey, if I generate a ton of business losses, won't that help offset my income and get to a zero tax bill? Mm-hmm. So before I say anything, nobody gets down to a real zero tax bill. It's almost impossible. That's number one. But number two, there is this thing that you mentioned called excess business loss limitation. So what is that? Well, think about it like this. You're making all of the salary. Like I said, you may want to increase your losses through your business. You may do things like what, Charina? Let's say R&D credits or maybe a cost seg, right? So you guys get people like this all the time because that's their motivation, right? So they come in.
Yeah. And that's my first question that I get. Okay, well, we're able to unlock these massive losses with cost segregation, but now on the CPA side, what's happening? We want to really understand what the roadmap is, what the roadmap is, and then make sure that we are really understanding what we're getting into.
Right. So basically, this is what kind of differentiates a reactive versus a proactive CPA, right? Because these are the kind of things that you can plan ahead on. So we're going to talk a little bit about what the EBL, as far as kind of like, what those numbers are, what the limitations are, what they mean for you. An example of how someone could run afoul, right, of the thinking that they have, because obviously these EBLs exist. And then we'll talk a little bit about how we can work around that, which is, what most people want to hear about. So excess business loss limitations. So for 2025, one big thing that most people don't know, and we were talking earlier, Charina, and I know it was a surprise to you, is that this is one of those things that was permanently written into the tax code. So, you hear all these guys online, talking about all the pros. This is one of the negative items. And there are some negative items on this bill, believe it or not. So yeah, this is going to be permanent. It's $313,000 in 2025 for single filers and $626 for married filing jointly. Now, is that basically the limit? No. Well, the limit is basically they're going to look at your business income plus any IRS set threshold. So again, the thresholds are $313K for single, $626 for married filing jointly. Anything beyond that, and here's kind of where it gets sloppy, Charina. Anything beyond that is going to be carried forward as an NOL, net operating loss. But then even then, right, you're talking about an 80% limitation, right, based on your income. So you can only write off 80% of your income. So this is what I meant when I was saying it's almost impossible to get a zero tax bill, right? Because of these kind of things. So the thing about this too is, and a lot of people don't know enough to think about this, but there's already limitations to that loss. Even before we talk about EBL, what am I talking about? I'm talking about passive activity restrictions, which we know, right? Obviously, you can't write off passive against active. The other limitation you have is at-risk limitations, meaning that's kind of like, I like to tell my clients, that's the skin in the game. So basically, you cannot lose. You can't write off more than you've invested in the business. That's your at-risk limitation. How much are you at risk for? So that's a big one as well. So, and of course, you have basis rules, which we're going to get into next week. So make sure you watch that, and we'll kind of give you a full breadth of what that looks like. So there's already like things working against you as far as those losses. So then here comes EBL, right?
Right.
That's where people this is like something where like people really get disappointed, and they're kind of like, what do you mean I can't do that? What do you mean I can't? That's not fair. But those are the kind of things that you need to be watchful for. This is why you need to work with somebody who's proactive.
Great, Jose. That's such a great set of information that we all need to account for as we are advising our clients. So tell me a little bit why using an average CPA can hurt you. What are the differences?
Yeah. So just imagine you're planning all year, right? You have this high income. Let's just say you had a windfall this year, and you're getting all this income in. You're planning. You're doing the best that you can to plan ahead and get these losses, hoping that they can write them off, right? Just it wipes off. But you're unaware of the rules, right? So working with a tax filer, right? Someone who punches in numbers into the software and then spits out a tax return, right? In most cases, they're not going to be aware, or if they are aware, they're going to charge you a lot more, right? To get that value, to get that service. So that's already one thing. Now, let's just talk about even before you get to that tax preparer, right? Well, you don't have anybody to kind of tell you these things. So during the year, you're kind of going, like I said, you're doing the best you can to try to, mitigate that income, but you just don't know what the rules are, right? You may go online. It takes time, right? And plus, it's like you want to work with someone who's obviously had these situations and dealt with other clients with situations like this. So that's where the proactivity comes in. That's where having that coach, right, with you side by side, reviewing your income proactively every quarter. That's where it kind of starts really, you start seeing that value because you get
right. And it's also like the clarity of having financials up to date. If you don't have a bookkeeper and someone that's constantly evaluating and reassessing your situation, because everything changes. We're never going to stay the same. So it's very important to have someone that's constantly looking at what's happening. Are the projections in line with what you were expecting, or the actual results are in line with the projections that you created? And then obviously pivoting as necessary. And,
even with that, what you just said, and thanks for mentioning that, because obviously, if you're not familiar, if your thing is not numbers, obviously, and a lot of business owners out there and entrepreneurs are not, it can be kind of hard for you to kind of even tell if you're working with a good bookkeeper, right? Because you're kind of like at their mercy. You don't necessarily understand enough, and you're not getting coached, and you're not being taught these kind of things. So even then, it's like when I work with my clients, I can basically consult them and say, hey, the bookkeeping's not where it needs to be. And then from there, obviously, you take measures to do that because it's so critical, because it's garbage in, garbage out. So
correct. Checks and balances.
That's right. Checks and balances.
So much needed. So let's talk about some practical illustrations, how this would look like for a single filer versus a married person that's filing jointly, and some other examples that you may want to share.
Right. So remember, the difference between the single filer and the married filing jointly is just obviously the threshold. So we have 313 on top of their business income, right, as your threshold. And then, of course, you have 626 for the married. But I do have, Charina, an example. Like this is kind of like one of those perfect examples. Last year, I got a call from a gentleman who had a big windfall, like I mentioned earlier, who had a big windfall. I think they got some stock options and whatnot. And his wife is a real estate professional. So logically, he would think that, hey, they already invest in real estate, right? Let's just get these cost segregations done, which you guys, obviously do so well. And let's get as much loss as we can, and then poof, it'll go away, right? The tax problem will go away for that year. Well, that's not necessarily what happened. So basically, they came to me, and they came to me because they had heard about this concept of excess business loss limitations, obviously once it was too late, right? So they wanted to confirm and see what they could do about it. So basically, what could we do about it? At that point, they had generated, obviously, a lot of losses, But because their salary was so high, I told you, I think it was 800K in stock grants, and like almost 3 million in stock options, plus his regular wages. You can imagine, right? That's EBL is a hard threshold to reach. I mean, it's already high, but he had a really good year, obviously, and it was way above. So yeah, so he was kind of stuck there. So basically, what we wound up doing, because he came to us so late, right, is we got him into some tax advantage investments, and that helped kind of mitigate some of it. Wasn't what he hoped for, but hey, you know, we got him something. We got him back some money. But you know, that's the thing. It's like, had he called me in, say, March after the first quarter, or even after June, because at that point you're kind of starting, with every quarter you start seeing where the ship is sailing, right?
Right.
So at that point, you know, we could have done something, maybe, you know, some other things. So speaking of those some other things, I'm going to talk a little bit about what kind of strategies we can do. And I'm going to talk high level because obviously, you know, I don't want to throw in minutia or whatnot, but there's a few things there's a few things we can do. And this is basically, if you remember, Charina, and I'm going to kind of introduce this concept to the audience today, we have these 6 pillars of tax planning. That's the way I call them, right? Basically, the first pillar is income shifting. So would that apply? And this is kind of like how I think about it when somebody comes to me with their tax returns and looking for tax help for tax planning. I basically kind of throw those tax returns against these 6 pillars and see what opportunities there are. First one's income shifting, right? So can we move income back or forth, you know, between different time periods, between different people? Think you're hiring your child, right? That's a good one, right? Or between different entities, because different entities get taxed differently. So those are one of those kind of things that I look at that and say, okay, you know, is this something that they can do right now? If not, and here's another big difference between a reactive and a proactive CPA. If not, how can we do it? Right.
Yeah. And that's what we're all about. It's just being proactive and not reactive. So
exactly.
How the hell do we work around that and make this happen and not make the same mistakes that we've made in previous years?
Yeah. And this is where, you know, they say us CPAs are not creative, right? We don't have a creative bone in our bodies and all that other crap. This is where someone who you're working with is creative. This is where they start thinking out the box. Okay, you come in, you have this loss. All right. Maybe you have an S corp. Can we start looking at different lines of business that you have, and can we maybe throw that into a different entity where it might help you? You see what I'm saying? So those are the kind of things we want to think about. It's like, how can we get there? So income shifting is the first pillar, and it would apply to this situation, right? Because here in this case, what do we want to do? We want to accelerate, right? Because obviously you want to be able to get as far. You want to take as much advantage of those deductions and those losses as you can.
For sure.
Right. Expense shifting is the second one. So we're looking at the other side of the thing, right? So what do we want to do, right? Can we defer expenditures, right? So that your expenses go down, your income will eat more of that, those losses, right? What can we do there? Can we defer expenditures in one way or another? You know, vendors, whoever it is, work with them. Again, the point is thinking out of the box, seeing what you guys have, and then let's see how we can play with what you have where you're at right now, and then see what we can do otherwise, right? This is why we always ask for tax returns, Charina, right? Somebody once asked me, this one guy calls me, he's like, well, I don't want to show you my tax return. Well, how can I help you? You know what I mean? So this is why it's so important. The third one won't apply here. It's loopholes, but we'll talk a little bit. We're going to get into all this kind of stuff in the future, so sit back. Here's another one that can apply to income character recharacterization. How can we, now maybe you have some passive income or passive losses that you can't write off. How can we turn that into passive income? Is there a way to do that, right? So changing the nature of the income that's coming in. And then, of course, the last one's investments. So spend money to reduce tax. Right? That's what we had to wind up doing with this gentleman here. Like I said, you know, it helped him. We got him, you know, better than he thought he was going to be. But, you know, those are one of those kind of tax surprises that really piss people off, Charina.
Yeah. And that's another topic that we're going to be speaking and covering in future episodes, the alternative investments that have that tax mitigation tool attached to it. So those are very interesting, and depending
Misunderstood. Very misunderstood.
People need to know what's available, and this may change every year. So it's so important to stay educated and understand what are the limitations that we have.
Exactly. So Charina, we got something exciting to kind of talk about. We activated the chat feature in our Substack publication, CPA Revolution. So now you guys, you have a question, you want to chat with me. You have any kind of question where I can help you, feel free to just comment in the chat box. Always monitoring it, and we'll get back to you within 24 to 48 hours. But figure that's something that is well needed, right? It's just somebody to ask a simple question to kind of help you as, we're already coming into September. So, you guys are starting to think about those things. So feel free to drop me a line and we can help you out.
And I hope you all enjoyed this episode about the excess business loss rules, which is one of the silent ceilings that separates reactive tax preparation from proactive tax strategy. If you're earning more than $250,000 and building wealth through your business or real estate, you can't afford to discover this rule after the fact. The truth is, the right CPA doesn't just file your return. They help you forecast, restructure, and plan so that the tax code works for you and not against you. If today's conversation opened your eyes, share this episode with a fellow business owner. And remember, strategy isn't about avoiding the rules. It's about knowing them well enough to play the game smarter. Thank you again, and look forward to our next episode.